Hey everyone, my name is Alex and welcome to another video. In this video, we're gonna walk through the entire mortgage qualification process. So if you are looking to purchase a home in 2021, this is the ultimate guide from step A all the way to step Z. So I'm a licensed loan officer in the state of Utah. We'll be in Nevada by the end of this month. And really what we've done is we've broken down the mortgage process into 4 simple categories. I'm gonna talk to you about the 4 simple categories so that way by the end of the video, you're gonna have a very good understanding of what to expect when going to get qualified for a mortgage loan. Now, the first thing that we look at to get you pre-approved is your credit score. Now, typically, as you'd imagine, credit scores are really important when it comes to getting the best interest rates or loan terms for your mortgage loan. Now, I will also tell you on the other side of the coin is that credit scores are a little overrated. I like to tell a lot of my clients that credit is kind of like the invitation to the party. Once you get into the party and you're in, then you have nothing to really worry about. Now, depending on your credit score, it's going to really tell you what loan options are available to you. Not only does it tell you what interest rates you qualify for, it tells you what mortgage insurance, if you have mortgage insurance, it tells you what your mortgage insurance premium is going to be on a monthly basis. Also, it's going to tell you what loan programs are available to you as well. So ideally, I tell my clients that if I could tell them where I would love their credit score to be, I tell them to shoot for 660 or higher. The reason why 660 is the mark that is so important or higher, because at 660, you're typically going to have down payment assistance programs and you're going to have all of your FHA and somewhat conventional options available to you. Now, I'm not going to talk about the differences between the different types of loans here. We'll save that for another video. But ideally, if you're going to go conventional, we want you at a credit score of 700 or above. Now, you do not need to be at 660 to qualify for an FHA loan. Depending on certain lenders, depending on the market and what kind of risk exposure and what kind of hedges that lenders are putting on risk, you can get a FHA loan from 580 and above, sometimes at 600, and it really just depends. I don't want to necessarily generalize because everybody's a little bit different. So what I want you to take from this section is to at least get your credit score at 660 or higher, ideally 700 or higher, and even better if you're going to be doing a conventional loan, 750 or higher to get qualified for the cheapest mortgage insurance and the cheapest interest rates, all while having all loan options available to you still. Now, the second category that I typically walk my clients through when we're getting them pre-qualified is down payment. Now, a big misconception has been you gotta have 20% to purchase a home. Now, that is just not the truth. There are so many down payment assistance programs that's little to no money down, to 3%, 3.5%, 5%, 10, 15, 20. I mean, really, it just varies, right? Now, I typically ask my clients what they would like to do and what they were expecting when walking into my office. Now, I typically suggest, because we have down payment assistance in one bucket and we have money down in the other, on the other side of the spectrum, there's pros and cons to each option. There is not a perfect loan program out there. And if there were, you probably wouldn't be borrowing the money, right? But our job as mortgage loan officers and your job as a client getting ready to purchase a home is to, you want to give yourself many options as you possibly can. So I tell them, hey, cash is king. Keep your cash, save your cash. Now, then when we're going through that pre-qualification and exploring all mortgage options that are available to you, you then have an option to decide if you want to go down payment assistance, and then you can also look at all the pros and cons of that option. On the other side of the spectrum, you can look at using some of your cash for the down payment. So far we've talked about number 1, credit, and number 2, down payment. Now, depending on what loan program you go with down payment, if you do want to put money down, it's going to depend on how much money you need to do. Now, for just a simple case and a rule of thumb, FHA loans are going to require 3.5% Conventional loans are going to require sometimes 3% to 5%, which is more popular as 5%. USDA loans, there's 100% financing, so no money down. And if you qualify for a VA loan, you're also going to be 100% financing with no money down. The third thing that we look at is your debt to income ratio. Now, your debt to income ratio is often overlooked by clients when they're walking into, and getting ready to purchase a home, because it's not something that we learn in school. It's not a calculation that we're really ought to learn. Now, it's my job, and again, and the reason why hopefully you're watching this is to set you up so you can get the best loan options for you and your family when buying a new home. Now, your debt to income ratio is a qualification ratio that lenders do to assess your affordability on that property or that mortgage loan. So essentially, it's a very simple calculation. What we do is we take all of your monthly debt obligations that are on your credit report. Now, we do not take your Netflix or your gym bill or your phone bill into consideration into this calculation. So only take things that you're paying back on your credit report, most notably auto loans, student loans, credit cards, right? Things like that. So we take all these minimum payments on all trade lines that you have, we add them all together. So let's say you had an auto loan of $100 and a credit card of $25 a month. We take those minimum payments. Then what we do is we're going to add it to your new mortgage loan on the home that you are wanting to buy. Now, this new mortgage loan payment isn't going to consist of everything that's going to consist in that mortgage. So you're going to have principal and interest. You're going to have taxes. You're going to have insurance. If applicable, you're going to have mortgage insurance. If you're going to have an HOA, you're going to have an HOA. If you're going to have any subordinate financing, that's also going to get added up into that total mortgage payment. So the calculation reads like this. We take all of your monthly debt obligations, we add it to your mortgage payment, and then we divide that figure when you add them together by your gross monthly income before taxes or deductions. Now, what this does is it spits out a percentage. And for a good rule of thumb, conventional loans, you want to be under 50% debt to income ratio. For FHA loans, you want to be under 56% debt to income ratio. The last and final thing we're going to talk about is your income and job history. Now, your income and job history is so important because it ties directly into your debt to income ratio. If you have more debt in your debt pad or on your credit report, you need more income to offset that debt, right? So this last bucket is kind of broken into two things. We have the history piece and then we have the income piece. Now, the history piece is most lenders are going to require 24-month work history. A big misconception about this is that you got to be working at the same job for 2 years, and that's not true. Now, we do document a 24-month history, and it's important to not have any large gaps of employment because then we're going to have to then explain it, and it gets a little more messy. The next thing that we look at is the income. Now, there's lots of different types of income. You have salary income, which is the easiest income for a mortgage lender to qualify you with. So if you have your salary and you know what that monthly gross number is, you're going to plug that number into your debt to income ratio and be able to calculate your debt to income on your own. Second type of income we have is your hourly income. You're going to take your hourly rate by your full-time hours. Typically you see 40 hours. Then you're going to come up with a gross figure for that, right? What we do as a lender is we make sure that you're working those hours and we do not see a lot of fluctuation or volatility in those hours. We don't like to see it being variable. So if you are currently working hourly and you are not working a full 40 hours or, if your line of work, what is ever deemed full-time in your line of work, if you're not working full-time, then that can cause issues with your qualification. Now, typically clients that are having issues with their mortgage qualification, this is typically where they run into a lot of issues, where they're not prepared prior because they're typically not aware how many hours you work is actually important. And a mortgage lender, when you're getting qualified, is going to look very deeply at that. The third type of income I'm going to talk to you guys about is variable income. That is income like commission, overtime, getting paid through tips, right? Piece rate, any kind of income that is variable in nature. what we have to do is we have to take a 24-month history of that pay type. So if you're commission and you've been commissioned for 2 years, we're going to take the 2 years and divide it by 24, which is going to give us a 24-month average and a snapshot of your income that is consistent enough that makes the lender kind of hedge that risk. So to recap the 4 things that we talked about, number 1 was your credit score. Number 2 was your down payment. Number 3 was your debt to income ratio. And number 4 was your income and job history. If you structure your finances to, consider each of these 4 items, you're going to have no problem getting qualified for a home. So anyways, guys, I hope you found this video really valuable. This is, if you have not noticed, is my first video on YouTube. So if you guys can do me a favor, like and comment down below, share it with someone in your friends or family that are looking to purchase a home and don't know where to turn to get valuable and accurate information. So hope see you guys in the next video, and I'll talk to you guys then.